Welcome to Views from the North, a Canadian rates and macro podcast. This week I'm joined by Andrew Wallace, one of BMO's Government of Canada bond traders. This week's episode is titled Front-End Follies. I'm Ben Reitzes, and you're listening to Views from the North. Each episode I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated. Andrew, thanks for coming on the show again. Always appreciate your time and opinion.
Thanks for having me, Ben, and good timing here. We're recording this, I guess, at halftime of the Canada game, so we'll try to make it a somewhat quick one, I guess.
We're going to have to, because we got to make it for the second half. And halftime's not that long. So a few things, I guess, are highlights in the market at the moment. Chief among them would be the richness of Canada against the U.S., and that's most apparent in the front end, correct, which is where you trade.
Yep.
So, which is why I wanted to bring you on. So this works out well. Now you know why I brought you.
Yep.
Do you think we should be here? Or is this egregious? Is Canada set to get destroyed? Or, I mean, are we in the right place? Is that, like, I guess, what are the flows you're seeing and how do you view things?
Yeah, so a lot to get into in this, obviously. I guess the first thing you see is when you kind of look at take cross-market twos, for example, around minus 142 area. There's kind of that bit of sticker shock look, just looking at the number and thinking, wow, like that seems stretched. And certainly, the move from, minus 100-ish mid to late May to that level is pretty extreme. You'll hit on some of the data and how that has been kind of the primary driver of it, for sure. Canadian data suggestive of a bank that is probably going to be very reluctant to hike rates, especially under the dynamic of energy prices coming off recently, versus the U.S., where, the data has hung in extremely well, obviously. So you've had divergence on that front. You had Warsh and the market interpretation of that. So fundamentally, just looking at that, Canada, the story of Canada richening pretty significantly does make sense. I think, too, when you look at it, where policy rate is, the cross-market 2-year spread is pretty well bang on the difference in overnight rate between Canada and the U.S. right now. So if you look at it that way and say, okay, are the central banks, which one's going to hike or cut first? And the argument is starting to drift towards, well, it looks like the Fed's probably going to hike before the Bank of Canada is, if that's how it plays out, then it's not that crazy that it's, minus 141-ish, 142, like we said. So breaking it down a bit, it makes sense a little bit where it is. You look at the C$ too, which I'm sure you'll hit on. I'll let you comment on the Canadian dollar, but when you look at it that way, it kind of makes sense. Now, one of the primary drivers of why Canada has richened so much isn't necessarily that we're seeing a lot of buying in our space. In the front end in particular, I'd say the flow has shifted a little bit recently towards selling our front end, some of which will be cross-market, some of which will be outright after the outright richening. But the futures market has been extremely well bid. And I think that is just the market has gotten the soft data, has gotten a Bank of Canada that certainly hasn't really been hawkish, and they've been very comfortable piling into long Canada positions, especially in the front end through the May to June period. Before we get into the futures market, I don't know, maybe if you want to comment, I'll comment on the data.
So many things.
Yeah, because the futures market, there's a couple interesting developments there that we'll hit on specifically, but I guess fundamentally we maybe let you comment on the data before we get into that.
Sure. I mean, quite frankly, there isn't that much new to cover at this point. The story for Canada hasn't changed. It's not going to change. We remain at the mercy of trade until that dynamic changes. I don't see how the Bank of Canada can raise rates. I guess if inflation were to explode higher, sure, but like that risk is now apparently gone. Oil is back at 70 or slightly below even today at some points. So the inflation risks have subsided somewhat. I guess the dynamic on the Canada-U.S. spread that I'm most interested in, like I think it's effectively a U.S. move more than anything else. That's what I wrote in my piece this week, and that's what I think. And I guess I'd be curious on your views on and this is totally not our wheelhouse, but man, I just can't help it on Warsh and the way the market interpreted the Fed, because I don't see it the way the market sees it.
Like, in what sense you don't see it the way the market sees it?
I mean, we're now pricing in a much more aggressive, hawkish Fed than we were.
Yep.
And I get that he wasn't as dovish as Powell was before, but I think he was nothing. Like, he wasn't hawkish and he wasn't dovish. He just didn't tell us.
Agree.
He just didn't tell us anything. And so, like, maybe he is dovish. I don't know.
Yep.
Maybe he's hawkish.
Totally agree.
I also don't know.
Now, my view on that would be that evidently the market just expected him to be dovish coming in.
So this is the problem. So I had a meeting earlier today, and somebody made a great point, and he was like, well, this is his first meeting. He comes in. Everyone expects that he's Trump's lackey. He's his boy.
Exactly.
And going into the first meeting, you kind of want to make it clear to everyone that, like, you're not that guy.
Yep.
And the way to do that is to be like, 2% inflation, 2% inflation, 2% inflation, 2% inflation, when clearly President Trump does not care about 2%, or seemingly doesn't care about 2% inflation. And the Fed's missed it for years. And so he comes out guns blazing with 2% inflation. But, like, what did he expect him to say? Like, what else was he going to say? Isn't that the right way to do it?
No, exactly. And I think that's right. I think he established exactly that he's going to operate his way and he's not Trump's lackey. I think maybe there's this overarching opinion that as soon as there was a change at the Fed, that with Trump's new appointment in, that it would be a dovish Fed. And
it still might be.
And it could be, for sure. For sure it could be. And to your point, we didn't really get anything from that. It was pretty straightforward. I didn't read anything dovish or hawkish really about it. It was just,
he told us he's not going to tell us.
Yeah, exactly. So I think the trade and what happened was just the market was caught the wrong way in the sense. I think it was just kind of overhanging, lingering expectation that when we get a change in the Fed and Warsh comes in, it's going to be, dovish because, Trump wants interest rates lower. Seemingly, that's what the platform would have been for getting the job. But evidently that's not the case, and nor should it be. So I'm with you. I think the market reaction was more, obviously about positioning than it was, a read on Warsh being hawkish.
Okay. So this will, we're unwinding out some of it today, so it'll probably continue. And in that scenario, you probably do have Canada cheapening there, because the U.S. rallies, Canada will lag that rally the same way that when the U.S. sells off, we outperform in that scenario.
Sure. I think, yes. I think Canada underperforms on the U.S., positioning being cleaned up, a bid to the front end being reestablished, and a U.S.-led move. Yes, it probably does. Probably Canada's front end stalls out here. Like, we're not going to get anything in Canada either way, I don't think, for a little while. Like, in that sense, like when you look at the calendar, we have GDP next week. Sure, it's April data. That doesn't change anything. I think
it should be good though. It's going to be decent. And then StatsCan already highlighted they are at plus 0.4. I think we're a little softer than that at the moment, at least, but it should be decent. So, so good start to the second quarter.
So at the margin, probably bearish for Canada cross market. Yep. Sure. I don't think it's going to be a major market move.
Agreed.
Jobs would be the next thing. July 10th, I think, is the date. Obviously that can move the needle to a certain extent, followed by the bank, but the bank won't have inflation data at their next meeting. So it's going to be more of the same from the bank.
Yep.
Like, it'll be completely balanced in the statement unless something drastically changes in the Middle East front, or those two data points we mentioned are such outliers that they have to comment on it one way or the other. So it really, the cross-market trade probably does, to your point, become a U.S. trade more than a Canada trade near term. So yes, if you see some U.S. data coming off, if the market starts interpreting, or there's indication of, slightly more dovishness than current pricing, then yes, Canada front end cheapens back versus the U.S. Some of that, as you mentioned, is underway today. I think the other factor, and now's a good time, I guess, to get into the futures market and some of the developments there that could drive this spread one way or the other. So if you look at open interest in CV futures, which are the 2-year bond futures contracts, the open interest climbed pretty significantly through kind of mid-May to mid-June.
Okay.
And that was the period where we had kind of soft data period. U.S. was strong. You started to get that divergence. That was the moving in the cross-market spread from minus 100 to minus 130-ish. During that period, open interest in CV going up. really tells you an establishment of new longs. And it really felt like that the whole time trading through kind of that period, late May into early June, where futures market in the front end was just extremely well bid, and it just drove that cross-market spread richer and richer. What we've seen now over the last kind of 1.5 trading weeks, that open interest in CV has dropped significantly. And what it feels like in that side, if you look at it from that standpoint, is those longs that were established, whether they were outright or cross-market, it would have probably been a combination of both, are unwinding their trade. We haven't seen it play out in terms of the cross-market spread cheapening too much until today, really. But if that is the trend, that those longs are unwinding, and we're starting to see that in the cash and swap space as well, then yes, you have that kind of positioning trade where, there's some pressure on the Canada front end from longs to getting taken off.
And then the question is, I guess, whether those algos continue that move and actually go short.
Exactly.
Or flip back to accumulating a long position.
Exactly. And very, very hard. Like, we'll never have a read on that. We do our best of tracking kind of the open interest relative to the price action and what that's kind of saying about the skew of the flow and the trend. But yes, if it is kind of the trade right now is unwinding of longs, then you don't have that persistent bid to the front end to richen Canada's front end further if there isn't a fundamental reason for it. And as we mentioned, in Canada, there probably isn't going to be over the next 2 weeks. So I guess, fundamentally, as we discussed, based on data, energy prices coming off, the outlook probably makes sense why we're here. Does it mean it's hard to foresee it near term going richer? Probably. Especially when you couple in kind of that trade that's going on in the futures market.
Yeah, okay. I like that. Okay. And with oil prices coming off the way they are, like Fed rate hike odds also have to pull. That's another reason beyond positioning in the US that just doesn't make a whole lot of sense. And in Canada, the bank has made it pretty clear they're not overly enthusiastic about cutting rates more. So something seemingly drastic has to happen. And the scenario they paint is a trade explosion effectively, which I don't think is likely. People can disagree with me all they want on whether there's going to be a USMCA deal or not, but it doesn't look like Trump's going to rip it up. Like if that was the path he was going to go down, I'm pretty sure he would have already done it.
Yeah,
because you could do it anytime. There's no clock on that one.
Yeah. So I guess if you're kind of looking at the cross market trader Canada's front end from the standpoint of bank being on hold, energy prices remaining down here. The inflation data for June should be very soft, as you've mentioned. You kind of you're not going to price in any more, hikes per se. You probably start taking fully out hikes potentially later for 2026, but
there's only like 15 or 17 basis points
exactly
for the year, which we probably just roll that out as calendar goes by. But
yeah.
I don't think it rallies on its own. Like it's 6 months, whatever from now, it's going to stay in that.
Yeah,
kind of just under a rate hike until something changes. So what that is probably has to be trade, or maybe we get some kind of made in Canada momentum. Maybe Carney's investment seminar in September gets people excited somehow. I kind of doubt it moves the macro needle, but you never know. Or some other project actually gets started. Who knows? I think sometimes it's hard to tell on this, but if Canada can manage to make some macro traction, that would change things. But for now, that's kind of hard to see. We're stuck in the mud here, which makes the rate market a hard call because at some point, the wheel catches and you just go. But I don't know where that is.
Yeah, and I guess as we're hitting on a little bit here, the bid to the belly of our curve is. When we talk about this shifting of, where the bid to Canada is right now, it's kind of shifted the last couple weeks to the belly of our curve. And what we're seeing, and I'll just hit on the open interest in CGBs, the 10-year futures contract, that has climbed significantly to fresh highs over the last number of days. Couple that with the price action in terms of, the Canada-US spread, but also how 10s are trading on the curve. It feels like the market and the CTAs are getting long CGBs, and that's been the trade there. So we've had kind of an unwind of the front end long positions, but at the same time, the OI and price actions telling us that new longs are continuing to be established in the belly of our curve, which is what's driven the 5s, 10s, 30s fly a lot richer and led to the relative strength at our 10-year point over the last 2 weeks. So, again, to an extent, even if you have a situation where there isn't that bid to the front end of our curve in the futures market, as long as the 10-year point is bid like it is, it will drag the front end along too. So it's
drags the whole market.
Yeah. So, the belly of the curve has gotten pretty interesting now. Even, the cross market 2-year, as we've discussed, but the belly of our curve, relative to other tenor points and also cross market is now probably going to become a bit more of the interesting point, I feel like.
Yeah, 10s on the curve richest since 2023 on a constant maturity basis.
Right.
Which is notable.
Yeah.
But it also reflects the fact that like the outlook for Canada is not great, which means rates probably just go nowhere for a really long time.
And it also, part of that is the relative weakness of our 30-year sector.
Yes.
Over the last, call it month, 6 weeks for sure. As our front end's bid, obviously that puts, some steepening pressure on the curve, which we saw, but then supply. Like we can't go through this podcast without talking about the impact of supply over the last, month in particular, right?
You mean all those mega bond issues?
Exactly. Like, Google comes and we're kind of, surprised to an extent how well the market absorbs it. We get through the June extension. We have kind of persistent steepening interest through that period. So that nullifies the impact of any natural index buying in the long end. But then also, you get Amazon, who does almost 5 yards of long bonds. The provinces are still active. Yes, they have been issuing a lot internationally, but they're still issuing quite a bit in our market in 10s and longs.
We're lucky they're doing all that internationally.
Yeah,
otherwise, I don't want to know what our market would look like.
Exactly. And it wasn't just Amazon. We're seeing other corporate issuers come in, the long end of the curve. So you couple with the interest with, people wanting to be in steepeners generally, and all that supply, and the long end's just been the 30-year sector's just been trading kind of really heavy for the better part of a month under that dynamic.
You can look at it on the cross market basis. That is the one sector that has really lagged on a cross market basis. It has cheapened, whereas 10s kind of stalled out and 2s and 5s continued richening.
Exactly.
And so you can really see it there.
Yeah. So the cross market box, the 10s, 30s cross market box has cheapened almost 20 basis points from kind of mid-May, right? Back to, I think at one point today, we were almost at flat. We might have been even at flat on the cross market box, which is kind of an unheard of level over the last, number of months, number of years. And what offsets that steepening flow and potential supply is if the real money base were actively buying our long end. But because they've been able to get seemingly what they need from all this supply, and with yield levels kind of where they are right now, and Canada US levels at the richer end of the range, we just haven't had any interest to buy the 30-year point.
Yeah. And the outright levels are at the rich end.
So like 5s, 10s, sure, kind of whatever, but the 10s, 30s component has really put that richening pressure on the 5s, 10s, 30s fly. Couple that with the bid to CGB, and that's why that 10-year fly is so rich currently. Now, is it worth fading?
You tell me.
It's pretty extreme. Like you mentioned these levels, and so if you kind of believe, okay, with OI near all-time highs in CGBs, how much more buying or new longs will be established? Tough to say, but say it's close to being at its limit or close to it. Okay, that's a reason for perhaps 10 years to underperform a little bit if that bid subsides. If we get into the summer, which obviously we're late June now, and supply wanes, you see less 30-year issuance. The provinces are pretty well ahead in their funding program, so issuance will slow. The corporate market, is there's still issuance in the summer, but it's much less in the spring. So if you take away issuance, you take away perhaps that bid to CGBs in the futures market, you can see a reason why this 10-year fly kind of reverts back to a kind of more, normalish level. So I think timing wise, it probably is a decent trade to start if you're not already, establishing a bit of a short in the 10s versus 5s and longs.
Yeah. I'm looking at a super long-term chart on my phone here, and it looks like dipping your toe in here.
Yeah.
Just starting to add and every kind of like couple basis points.
Now it's been pretty painful. It's
straight down for the past kind of number of weeks, but it can definitely richen from here. Like over the past kind of 10, 15 years, it has been richer for a awful lot of that time.
Yeah.
But rates were also at zero for a chunk of that time, or 1%, or extremely low. Yeah. So
I just look at those two main reasons why it's here. The bid to CGBs in the futures market and the supply in the long end of the curve and the pressure on that, almost certainly the supply is going to slow down. So that's one factor that alleviates some of the pressure on the 30-year point. And tough to say on CGBs in the futures market, but if that does slow, then those two factors together should lead to a little bit of a re-cheapening of the 10-year point.
Yeah, start building a position here, but it can still go 10, 12 basis points, even more, arguably, before it gets back to kind of prior extremes. So a bit of a ways to go, but interesting trade. Something definitely to watch there. Anything else on your mind here? Or are we heading back to the soccer game with a relatively short episode?
Not much. It's been obviously a challenging market, I guess, to trade headline wise. It feels like to an extent through the spring, the market was somewhat correct in thinking that the Middle East would come to a resolution. And that's what we're seeing. If that continues, we're probably in for Canada in particular. Like we said, there's not too much to move the needle over the next couple of weeks. So yeah, I think you just want to, like, for the reasons we discussed, I think we just like being a little bit short the 10-year fly as a potential trade, but there isn't too much that sticks out otherwise.
We're just at the mercy of risk.
Yeah.
Risk assets and days where stocks maybe come under more pressure than we're used to.
And I think if you are, I think it probably is worth taking a look at short Canada US in the front end if you do buy into some of the reasons we're discussing.
I think tactically it makes sense. I think kind of fundamentally it's nothing to really move the needle a ton, but tactically for the reasons you mentioned, I think it makes a ton of sense. So awesome. Thanks, Andrew. Thanks for coming on the show here. Very much appreciated. And I think we can head back to the game now.
Awesome.
Go Canada.
Appreciate it.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.